Okay, right. Afternoon, everybody. My name is Nick Jacobs. I'm the chairperson of the Diversified range of funds. Just a couple of things for information from a government's perspective. I'd like to confirm that the funds are compliant with all the necessary governance principles. For example, all the funds are fully audited and up to date. They're all valuation exempt. They're compliant with the structure of the board. 4 of the 5 trustees are independent trustees. 1 is a sponsor trustee. The purpose of today's webinar is to provide feedback on investment performance and insights into the underlying managers and what's going on in the world. As a board, we're not investment experts, and therefore we seek the professional advice of people who specialise in investing on behalf of the funds, with the objective of providing inflation-beating returns over the members' working life. To achieve this, the boards have selected Horizon Advisory Services to partner with them to achieve the best desired result in terms of investment outcomes, considering the money invested, the time period of the investments, and the underlying market conditions. On that note, it gives me great pleasure to introduce Johan Buerter and Henry Nienaber of Horizon, who partner with us in providing advice and guidance in the management of the fund's investments. So I'd like to hand over to Johan.
Thank you very much, Nick. We always appreciate the time, and Mel as well, for setting up this session. We hope to provide you with another good explanation on where we are on the markets and what is waiting for us on the other side of 2021. We hope that we have a similar good year as to 2022. There are a couple of things that we'll touch on which could possibly make the year not as great as what we've had now for the last couple of years. In our commentaries in the past, which goes out to the guys, all of you guys on a monthly basis, we did mention over time that when COVID happened initially last year in March, on the markets for that matter, we always get a huge bounce back in the market for the next 24 to 36 months. And if you consider that it's about 20 months now that have surpassed, we should still have some feet and running left in the markets, but that will only be shown over time. All we can do is to look at the history, and every time it's such a huge negative event or an event that causes a negativity on the market, there's always a good recovery thereafter. So nothing new. We knew that, and it had to be there, except if it was the end of the world, and then nothing is worth anything in any case. So we're quite happy that the changes did occur as it did. The fund managers whom we have chosen and proposed to the Board of Trustees to utilize in your portfolios did do their job very well. We kept close tabs on them with due diligences on an ongoing basis, whereby we assess whether the guys are seeing the same picture as what we are seeing. And if there are concerns, we do show it to the Board of Trustees on the quarterly feedbacks that we give to the Board of Trustees. And there's certain suggestions that we make with that. Those presentations are available with the Board of Trustees. So for record keeping purposes, obviously we have to adhere to all compliance and also to adhere to the IPS of the fund, which is the investment policy statement, which the specific funds or these specific funds have based on the PF 130 document, which is just a very good guiding principle as to what the trustees may and may not do. And in following that, we do protect the board, we protect the fund, we protect ultimately the employers, and then obviously the employees that are the end members to the funds. So that's the process that we follow every quarter. We do the due diligences on a quarterly basis at least, but when there are concerns, we do interim due diligences and ask interim questions to the different fund managers whom we utilize. We also test these fund managers against other due diligences that we do. So typically we'll do a range of due diligences with the likes of Allen Gray, Coronation, Prudential, which is now M&G, which you'll probably all know about already. They went through a name change, so please be aware that when you talk about Prudential, they don't exist as Prudential anymore, but as M&G, which is their London holding office. We have been privileged to visit their London office, M&G offices as well, and we did a due diligence at some stage there as well. So typically we'll do offshore due diligences as well. That affords us a parallel view on what the market says via all these fund managers, and then we can also ask the same questions in the employee benefit environment and make sure that the managers that we choose in this environment for the specific fund or range of funds are doing the job well. I see there's a hand that has gone up. Is there something or someone that wants to ask a question? I'm more than willing to answer questions during the conversations. Mel, can you see who it was? Okay. Please go ahead and ask the question. Okay. Maybe that was an error. If there are questions, however, if you want to type it, you can type it as well. But if you want to stop me and you're not sure about anything specific that we talk about, please do stop us. And we are more than willing to answer. If I don't have the answer at hand, Henry is sitting next to me here, so he'll be able to assist as well. All right, so in that process of assessing that we are with the right fund managers, we follow the market conditions closely. We related all of these back firstly to a starting point, and that is to look at the political environment. And the last time I spoke, we also followed a specific direction. We always look at the market conditions internationally via politics first. And then secondly, we look at the political environment locally. And then we try and assess, according to that, where would the safest place be to be invested in currently. When we've checked these market conditions or political environments and then economic environments, we double check that and measure it against what the fund managers that we utilize see as well. And because of the fact that we talk to a multitude of fund managers, we can actually measure each of them against each other. Because often what you find is that fund managers have a specific philosophy and process which they follow, but they do not see the other philosophy and processes. Whilst we are objective in that process, we can assess the philosophies and processes and understand whether the fund managers follow it closely, and do they follow the line from international politics, international economy, down to local politics, local economy, and then eventually into the funds. Because it doesn't help in our environment, it doesn't help to follow the ostrich syndrome. It doesn't help us to put our heads in the ground. As typically you would have seen in our commentaries last year during COVID, we didn't run up and down and ran for the hills, but we try to assess rather what's going on, what's the depth of this problem, and how do we find that out. We try and talk to as many fund managers during such a crisis environment, and then assess whether it's something to stress about for the medium, short or longer term. And our deduction on that was that it was a stressful environment for the short term, because a lot of people were put in forced lockdown, and obviously the switch on the economy was just turned down, and the economy came to a screeching halt. And that's an international economic happening that took place. So we had to assess whether that was a critical environment to be in. Do we now have to get out of investment, equity investment as an example, to up the risk, and do we go into the likes of property or cash or bonds? And our deduction eventually was to stay put in our different mandates that we were allocated to. And then we approached the fund managers to ask them when are they going to be more aggressive. So some guys are more tentative. We were happy to see that the fund managers that we utilize in these funds did make the right move, and they started to move more aggressive. And that was wonderful because it played into our favor, and we're still running on that wave. So the wave of returns are still going very, very nicely. September, we saw a little bit of a pullback, and that's just one of the examples that I can maybe mention. In September, the Chinese basically flicked the switch and they said, we're going to stop the economy for a while to focus on implementing communism again, and specifically on the edutech sector. So I'll make use of an example there. What happened in China over the years is that the GDP base grew significantly over the last 40 years to around 8% per annum in 40 years period. With such a large population, it's a huge growth that has taken place. Now, if you in today's terms have, let's say, an example, 7% growth on such a huge base, the actual growth from a total economic GDP perspective is huge. And therefore, the Chinese has a huge impact on international economy. Again, the ostrich principle doesn't apply. We can't ignore China. And it was interesting to see that Mr. Biden also now realizes that. So he was very quick on the draw, and I commend him on that. As Mr. Trump always referred to him as Sleepy Joe. Sleepy Joe was awake at that given point in time, and he quickly had a meeting set up with Xi Jinping, and that's wonderful for the economy worldwide. It's always good that the big elephants talk to each other rather than fight. And Henry always makes the comparison of elephants fighting on a piece of grass, and we are like the grass in South Africa. So we get trampled on when these guys fight with each other, and there's not a positive outcome for us all. So what happened before Biden and Xi Jinping got together again and picked up conversation or negotiations, we saw that Xi Jinping came out quite quickly and said, we're not going to switch off our economy for a long time. We basically just want to enforce that in that edutech sector, people in China start using the public sector schooling system again, instead of going online and getting English literature, as an example, as a subject from England or from South Africa or from the US, and then getting an unfair advantage as opposed to other people in China. So the communist principle was brought in quite quickly. Children, as an example, now can only spend 3 hours a week on the internet, and that's to try and get them into playing and doing different stuff than just surfing and playing online games. And I'm sure a lot of you are au fait with online games. I see that over the years, my children also actually play less and less on the online side. So in China, it was a huge thing. And obviously lockdown wasn't really promoting going offline. It actually encouraged online because you were tied up in your living space. So what do? You can go online and go and do gaming and watch movies, etc. So that's restrictions that the Chinese put in place, and then they lifted that. But what we saw during that period is the Nasdaq was affected immediately. The Nasdaq fell, the Dow fell accordingly, the S&P fell, and what that caused is a ripple effect in the rest of the world. So in September, we saw a pullback in our market as well. So that's the effect that China currently have on world GDP. It's a huge effect, and they also produce a lot of chips. So if there's no chip production, America can produce as many Fords as they like, and obviously soon with us as well. But without that chips, they are useless. And we saw some photos from some of the fund managers who showed us that there are air strips that are full of newly constructed Ford vehicles, which actually just stands there. They can't do anything. They can't sell it. And we see that locally in the second-hand market, as an example. I was quite amazed. My old car, the other day, I went to buy some wood for a fire, for a braai, because that's what South Africans do. We braai. And a guy stopped next to me and he said to me, don't you want to sell your car? And he actually gave me a price similar to what I paid when I bought it many years ago. And I thought, gee whiz, maybe I should sell it. But that's the things that are happening. The chips aren't provided for new vehicles, and therefore the sales of new vehicles do take place, but the waiting list is so long that people start reverting back to the second-hand car vehicle, and that pushes up the normal supply-demand principle, and therefore the second-hand car prices just pick up. So yeah, I just put that out there so that you can understand that it does have a definite effect on the markets. If those political things do happen, like it happened in China, like happened external factors like COVID, which happened in last year, March, it does have a definite effect on the markets, and we must be aware of it. And then that always obviously puts us in a position where we can advise the Board of Trustees to move more conservatively or to stay to the line. And this time around, from 20 months ago, we advised stick to where we are. And we had wonderful returns, and we are still having to see wonderful returns, which we are absolutely grateful for. And I specifically mentioned that because once you get arrogant in this environment, you'll be flattened very quickly. So we are very aware of the fact that we are only as good as the returns yesterday. And therefore we need to stick to our guns, keep on doing our due diligences, which we will do. Keep giving the trustees feedback and yourselves as well on our monthly commentaries, as well as the quarterly feedback to the board. And at most try and put everybody in a position where there's a high probability that we won't be surprised in any way. In saying that, with the markets that have run as significantly as it did in the US specifically, somewhere in future there must be some kind of a pullback. And what we can gather at this point in time is that the pullback would most likely be driven by inflation. And that would eventually cause a rise in interest rates, as has happened already, but with us it's just happened recently. But that inflation drive is pushing up the probability of an increase in interest rates. And when that happens, the markets usually take some kind of a knock. We're actually in a very good position on the US still, with a 4.6% unemployment rate currently. We thought it last year in April, May, we thought it to come back to 5%. So sorry about that, we were wrong. But still the job market out there tells us that there are an overload of jobs available, and that in essence it should not stop very quickly. So the one thing on the inflation which is holding back on the markets a bit and not causing the markets to pull back is the amount of relief that was pumped into the system. And unfortunately, when one receives a huge amount of payment from government, people go and spend. But stuff that hasn't come through yet is vacations, as an example. So people started to spend on stuff. So they bought stuff which will eventually lay down your house and around your house, and eventually you will never use it. But that's how people are. We buy stuff for no specific reason. So unfortunately, people didn't have any place to go because of lockdowns, and therefore they bought stuff. Now, that stuff buying principle has to work out of the whole system first before a real assessment on inflation can actually come to the fore. And that's only when we'll start seeing whether interest rates are going to be hiked severely, and that will cause a negative effect on the markets. So we may expect in 2022 sometime that the markets could pull back. The important lesson, however, that we've all learned during this 20 months is that when something bad happens, it's not necessarily bad if you hold on. If you don't hold on and you start selling into bonds and to cash, you may get a nasty surprise in that you go into an asset class which can't recover when there's a pullback in the market. So you never want to go into something in a negative environment which doesn't have the ability to recover. It's always important just to remember that per the graph here behind me, this is a 100-year graph that I've got here behind me. It shows pullbacks on the markets every now and then. It's unfortunately a prudential graph still, so I'm outdated. We need the updated M&G graph still. And it shows you a recovery always after a bad space in the market. And therefore, it's important just to hang in there. With my last commentary, which I wrote last week, it was very evident that we are still running, and but we are in a position where there's a possible pullback in the market. But looking at a longer term performance, a 3-year plus performance, the funds that we are invested in on the funds have recovered immensely well, and it's still on a recovery path, and we're nearly in double-digit figures at any given point in time in the performance history of a fund, of one of the portfolios. So we are at a very good space, but never become complacent, and it may pull back at any given point in time. So that's just a quick look at a peek into the US. The UK is a different thing. I have to be very careful here because our chairperson is a UK ex-UK or still maybe UK citizen, dual citizenship. But the problem is in the UK, I'm always concerned to be too negative about the UK. But if I look at Boris, he's struggling to find his notes nowadays. Maybe it's somewhere in his hair. But it is a problem in the UK at the moment. I can't see a real economy anywhere. Lockdown was not great to them, and also just before lockdown, they elected to go out of the European zone, and that with Brexit, they really caused a negative impact on themselves, which was just escalated when lockdown happened in COVID. The problem that has developed in the UK is that gas supply is dwindling. It's not in a good state. So when there's little gas, the prices go up. That's just normal economy. And therefore, people with fixed salaries or pensioners do struggle because they have to pay much more for their gas, and they are really reliant on the gas. Similarly, with a lot of the other entities, the people that have worked in the UK, like the Pakistanis, the Eastern Bloc country people, had to leave because of Brexit. And a lot of those people are truck drivers and taxi drivers and ticket sales people at cinemas and the Variety, the Wheel, etc., the London Eye. And then that causes a gap in the market, and that caused the truck industry to fall short on running supplies because they don't have drivers. So they are not in a good place at the moment. We'll see how it plays out. Hopefully for them it will play out well. And the last crisis that the whole of Europe, including the UK, is the COVID crisis. The infections, even with the vaccinations having taken place, the infections are rising at a rapid rate. And although the vaccinations definitely do help regarding deaths, there are unfortunately a lot of people that are influenced by the vaccinations or the infections. And yeah, we'll see how that plays out as well. So Austria, Germany, you probably saw on the news, all of them are in a not such a great space at the moment. So it's important for us not to be too aggressive allocated to the UK. The US still have got some legs in it. And China definitely also do have some legs in it, but it's a very specific market, and one has to make sure that you are invested with people that are well au fait with the Chinese legislation. So that's what we try and follow and what we try and assess with the fund managers as well. So yeah, that's just quickly in a nutshell how the world looks. I'll probably refer to the world when I discuss the other stuff as well. But taking that into consideration, we realize that the rand, getting offshore, you need the rand. And at the moment, you all understand that the rand is in the region of about 15.83 to the dollar, and similar to the pound and the euro. And that causes a concern because if the fund managers now take out too much at this high rand level, or this low rand level rather, the low value in it, somewhere in future you have to bring back profits. And if the rand has then recovered to what we follow on the purchase price parity index of around 13.80 to 14 at fair value, then you would cause a problem for yourself. You would cause a negative effect for yourself. So also the markets being at a high on the outside, you now go out, when one now goes out at a low rand value, and you invest in an equity base on that side, and suddenly the markets drop that side, and you bring back your rands, you're going to have a double whammy if the rand strengthened on this side, and a negative effect on your portfolio. So it's a juggling act for the fund managers to bring back international assets at a given point in time where it doesn't hurt the performance. And we're always on the lookout when you do due diligences to ask these type of questions to the fund managers. And they are always well informed, and sometimes the guys call it wrong, but then we call them and we try and show them what we see based on a variety of due diligences that we do with a lot of other managers. We obviously have to respect the different views, and we cannot just randomly refer one manager to the other and tell the guys what the other guys are doing. We've got that in our armory, in our quiver, and we have to use it at the right point in time. So yeah, that's the rand dollar is obviously always a difficult scenario. There's a lot of people that are doom prophets in saying, look at the rand, it's bombing out to 16, 17, 18 maybe. Now you must take all your money out. And then at this point in time, we would strongly advise against it, because you're taking it out at a very low level and you're transferring it overseas where the markets have run already. So you're putting yourself in a very dangerous spot. So what I'm saying there is, to us at the moment, it's a clear direction that local is lacquer, and we need to focus more aggressively on the local environment. So we asked that question to the different fund managers from a political perspective as well. Yesterday, we had a feedback session from one of the smaller fund managers, and it was interesting to listen to them as well. And they as well have a very positive view on South Africa. And so many of the guys, you can always see it in the balanced type portfolios where the returns was very good in the last 12 months. So there are a definite reason to be local at the moment. And then we come to the local politics. And if we look at the local politics, we see a lot of scrambling on the television. It's like there's no signal. And if one should just realize that if the media starts focusing on the mayor of Kanaland, where there's 1,500 people that voted for him in the whole of South Africa, then the news probably have very little to talk about. So we have to understand in context what's happening on the media and not follow the media per se, but rather look at the detailed analysis that the fund managers together with all their in-house economists follow. So it's a much better option for us to listen to the different economists and fund managers. They are much more au fait and in direct consultation with government, different entities in government like SARS, and SARP and Department of Statistics and Department of the Economic Environment. They are in the front line. They get quarterly updates from these different government organizations, and they're in a much better position to make decisions on allocations. So we try and feed off them as much as possible to understand where one should invest and should not invest locally, and then we guide the trustees accordingly, and they make the final decisions on this line of thinking. So locally, we think that although we had this bad experience with Eskom recently, where we had a lot of load shedding, the lights are on again. We saw subsequent to the load shedding, it was just interesting that the load shedding started to happen just prior to the elections taking place. It's very interesting, that's all I'm saying. And then after the fact, we came to understand that Mr. De Ruyter and his team exposed terrorist activities. So these things are real. People are trying to disrupt the development of South Africa for their own gain, most probably from a political perspective, the RET factions within the ANC, and also the likes of the EFF is obviously not very much focused on economic development, and we have to be aware of that. We're not running them down in any way. We're just objectively aware of it, and one needs to be if you talk about investments. So Eskom is actually not in a bad position. It's the maintenance is going on at a rate of knots. I try and follow it as best I can on a monthly basis, and to make sure that we get in a good position to understand what's going on. Similar to that, in enhancing the maintenance and moving over to clean power, or clean green power, if you want to call it that. There's good negotiations that have taken place with the likes of Germany, France, and England as well, whereby around 131 billion rand is pledged towards green development. So the problem that we came to understand is that even if the French, as an example, buy up a lot of farms in the Karoo environment, these farms are then converted into solar farms, you still have a problem in getting that amount of electricity onto the grid So there's cables, lengthy cables that have to be established, sub-boxes, sub-electricity boxes there has to be built, and storage facilities for that has to be erected. So it's not as if one just clicks your finger and then the green oaks are just up and running. It's a long process. Similarly, I listened to one of our clients that I visited the Eastern Cape recently, and he said it's incredible to see how many of these wind turbines have come up in that coastal areas in the Eastern Cape. So the things are happening. We need to be a bit relaxed about it, if one can be. I think we're all stressed out at the end of the year. It's been a good but long year. It's been a good but long 20 months. At least the investment environment is making up for all the negatives, but it still has been a tough time that we had to go through. And all of us has gone through it. So it's not as if it's only you as an individual, but we all had to adapt. We had to understand what the new economy is all about and in what direction it's moving. So I'll get to that just now. So on the local side, SARS also is going at the rate of knots. They're really doing well. We can look at the trade balance, positive trade balance at the moment, just to explain why SARS is doing as well as it is. That's at a positive of 352 billion rand currently. I haven't seen the new figure yet, which should come out anytime now. But 352 billion positive trade balance for this year, that's impressive. We all know that it's mostly from mining, in other words, the export in mines, the PGMs as an example. And the reason for that is a lot of the PGMs are used in the production of chips. So if you go back to China again, the import of some of the PGM materials are utilized to manufacture chips, and then the chips are again exported to the different people in the world that are building vehicles. So we're in a good cycle regarding PGMs, and there's no reason why the local environment should taper down immediately. There would be still a high supply in the manufacturing of the chips, and therefore export should go on. In other words, if you do export at these levels that we do, you also, the local mining houses makes a lot of profit. And that profit a lot of it goes into the coffers of SARS. So therefore, SARS's inflows has been exceptionally good. We'll see the final figures in the budget speech in February, but the current guesstimate is that we should have around 100 billion rand more in taxes earned this tax year than what we expected it to be. So not as opposed to the previous year, but what we expected it to be. So on the SARS perspective, we're at a good space. Based on all of these factors that I've started to mention, Eskom is in the process of getting better. Our debt to GDP ratio has been readjusted. That's done on a 5-year basis for each country in the world, and ours has been, so that's an objective reevaluation. So it's not our internal reevaluation, and we've been adjusted from an 81% debt to GDP ratio to 70. Now, that again puts us in good territory regarding the World Government Bond Index, because we can easily at some point in time be taken off junk status for our bonds as an example, and then we could form part of the World Government Bond Index, which again should lead to more inflows on our bonds. And as we understand from the fund managers, the bonds are at a good place at the moment, especially your longer term dated bonds gives you a good yield of around about 9.5%. So not a bad return for a relatively low risk type investment. So the stuff that that has a definite impact, but locally on the SARS side, it's not only the corporate environment that paid more taxes, it's also on the individual side. So we saw a good feedback from a number of fund managers on the individual tax earnings, and that also has been on a positive trend. So somewhere something is going right, and then that led us to the question of unemployment. And we are not 100% convinced, and we're on a drive to find out exactly what the unemployment rate in South Africa is currently. But what we are quite certain about now is that it can't be 40%, because if you have these GDP growth figures, these trade balances, readjustment of debt to GDP, all these positive, then you cannot be in a position where you have a 40% unemployment. So we'll still try and gather what that is. What we could have gathered by this time now is that with the grants that has been issued and the history in South Africa, the BEE environment caused a lot of capable people to go out of the corporate environment, set up their own businesses. They employ people at a week-to-week base or a month-to-month base, and not make them part of the formal in working sector. And in essence, the unemployment rate only measures the formal sector. So that is a concern. We're not sure whether it's really the actual unemployment rate. And we'll see what that figure becomes over time. But on the formal side, we do need more employment. We do see a lot of development, especially on the road here between in Pretoria. We're in our Pretoria offices currently, between Pretoria and Kempton Park. There's a huge developments that are taking place, huge production houses, distribution houses that are erected. And we see that to the north of Durban as well, in some areas in Bloemfontein, and in some of the Cape areas, the Western Cape areas as well. So there's a lot of development taking place, and that we eventually will see in the formal sector, bringing down the unemployment rate. So that's very positive. So yeah, the stuff all over is looking not as bleak as it seems. It also seems that with the elections, people are slowly but certainly waking up. And people are starting to understand that if I keep on voting for the same guys, we are going to see the same result. And that's the definition of insanity, doing the same things over and over and expecting a different result. So the results that we are seeing currently is very positive, in the sense that a more enlightened, I would say, more modern party is taking over all the metros from a management and a point of view. Hopefully they can take control of the finances as well, and really start applying the municipal budgets in the correct way, so that so many people can have access to water and electricity and proper housing. Also the road infrastructure, electricity infrastructure, getting rid of all the tapping that takes place in a lot of the suburbs, which shouldn't happen, but it is happening because people are desperate. And that causes a negative in that Eskom substations blows up because of the overload, and that causes a negative effect for so many more people. Talking about that negative effect, the looting that took place was a very interesting thing that happened. I eventually sat for about, I don't know how many hours, and watching the television screen, and I was amazed when we started to analyze what was happening. And I saw a lot of interesting things happening, a lot of very high-end product that was stolen, in essence, or looted, if you want to call it that. And then in between, food was looted as well. But I think whoever planned it, and whether it will come to light eventually, I do not know. But whoever planned it probably misguessed two things. They misjudged themselves on two aspects. And one aspect was the looting and stealing of these high-end materials or product. And the second thing was that they took the bread and the milk and the normal day-to-day food away from those ladies, that the omas, that are looking after the children in the townships, where the Soweto Mall, as an example, so many people are reliant on the checkers there, and the Pick n Pay, and clicks, and banking systems like Citadel, Capitec and FNB, etc. And those places were closed down. Suddenly now these old ladies who were used to just go across the street and buy the goods and stuff that they need for their children has to go to a Krugersdorp mall or somewhere else, and they have to now travel again. So I think it was wonderful to see that the community stood up, and they said, but you're absolutely taking the bread from my mouth now. So that was handled very nicely from government perspective. We saw that Ibrahim Patel was onto the international investors very quickly, which I think settled that very well, making them comfortable. There was obviously a lot of negatives coming out, like Toyota apparently saying that they're going to withdraw. I later found out that it was never the case, and that Toyota currently is actually expanding a number of their plants in Durban specifically. So yeah, there's a lot of positives that came out of the looting, and it's not always a bad thing if bad things happen. And then the next thing, obviously, we're waiting for is that the law takes its turn. I think it's very interesting that Mr. Ramaphosa follows a very, very good and solid, astute process for electing the new Chief Justice. Yeah, I think it's a wonderful way that he's approaching it, in the sense that some of the guys that we have a bit of a distrust in were also on the shortlist, the 7 shortlist people that were standing in line for the position. And slowly but certainly, one actually took herself off the list, and the other guy was eventually removed from the list, not decided on. And now you've got 4 good candidates, and from those candidates, you'll probably get any one of them can be a very good Chief Justice. I think with all, I nearly called him Dr. Zondo, but let's keep to that. If everything that Dr. Zondo did, I think it would not be a bad option for Mr. Ramaphosa to elect Judge Zondo to take over the reins from Mogoeng. I think the same line would be kept as what was followed with Mogoeng, and that the legal fraternity would come up tops. So that's wonderful. I'm legal qualified, so I'm very happy that the legal environment contributed to keeping the country relatively stable, and it can take us to a position whereby they add to the stability of the country. So from a legal perspective, when that stands, your constitution is tight, with not one party threatening the constitution or the change of the constitution in any way. It's very positive. Talking about the constitution, there's still no definite change to the compensation. What do you call it? The redistribution of land without compensation. That's a very good and a positive thing, because the change in legislation, as I understand, was very intense and it was very detailed, and therefore, yeah, I think it would have a positive turnout. I think what is important is that in that process, people started to realize that in the ANC as well, is that the instructions coming from conference was followed by Ramaphosa. He kept on with the redistribution without compensation principle, and he has fine-tuned it to such a way that it would be effected in a very positive way, not negative and detrimental to the economy or to any person that contributes to the economy and pays taxes to the economy. So I think the changes that are occurring is going to be very positive. All of those and a number of other things that is happening at the moment is showing political stability. And what foreign direct investment wants is political stability. As I understand from international surveys, is that the first thing that foreign direct investment people look for are stability on the political side, because stability on the political side will lead to economic stability. You don't want to be in a position where you purchase a property in South Africa and you erect a production house, and then suddenly your production facility is attached. That you don't want. So there needs to be political stability, needs to be economic stability, and that's the direction that we can see plays out in South Africa. So with J&J taking hands with Aspen, we'll start seeing the developments there as well. The purchase of Pioneer Foods by Pepsi is very good. That's very positive. Burger King has just been bought over. It was held back for a while because the guys that bought it over from the international side did not adhere to BEE, and in a sense that's a weird thing to do, because if you're in a German company and you buy a company in South Africa, you most definitely are not going to be BEE. So that is a concern and something that needs to be addressed if foreign direct investment needs to up the job environment in South Africa. Some people argue with me on that point to say, yeah, but now the international guys are purchasing all our good companies and they're taking the profits elsewhere. In a sense, that's true. But also, on the other hand, you generate jobs locally. Those jobs leads to people paying taxes, and you get a bigger fiscus. And with a bigger fiscus, you can keep on investing in infrastructure, and the wheel can keep turning, generating more jobs. allowing more people to set up their own businesses. And by doing that, you make use of the foreign direct investment to ignite your local growth in your economy. What Sussell is doing right is that he's not allowing the guys to come and buy. They do not. He doesn't allow people to loan, as the previous dispensation did want to do. Under Mr. Zuma, they wanted to eventually let the Chinese loan or lend a lot of money to Eskom, and eventually, if Eskom can't pay them back, then they obviously take the asset to themselves or for themselves, and that would be highly detrimental to our economy. So he came in luckily quick enough and to stop those type of interactions happening. So if the Chinese wants to invest in Eskom, please go and buy Eskom bonds. And you're more than welcome to invest in Eskom in that way. So very much on a positive trend where we are currently. There's a number of other things, but Melanie said I only have 45 minutes to talk on. To us, Henry and myself, we get so involved in these type of things that we'll talk for another 2 hours. But I only had to give a summary and a broad overview of, again, the process that we follow and the detail that we follow to get to the right investment managers. And we are comfortable that the process are working. Not complacent, but comfortable. And I did make mention of the fact that the one thing we need to all look at is inflation and the negative effect on interest rates and the negative effect on the markets that could come into play. But please relook this recording again when you get uncertain. You become uncertain when the markets do pull back, and be aware that it will come back again. So the fact of the matter is we may see negatives, but we will see positives in future again as well. So from Horizon side and the team side with Henry and Danielle and Karika, we also just want to thank the Board of Trustees for their trust in us and all of you, the employers and then the individual members at most. And obviously on Tennant side, the admin side and where the grinding actually takes place, where we make proposals and all the changes have to be implemented. And the sales team at Tennant building up the fund, wonderful. Thank you so much for everybody's contribution. And we are looking forward to a wonderful 2022. And with that, we wish you an absolute blessed Christmas period. And obviously that you're more than welcome to still asking a couple of questions, but I just wanted to say. Okay, under the type thing, Melanie said to me there is a question. All right, Annelie, you said, hi, Johan, which types of investments are the negative which do not recover? Steinhoff, if that's a good example. But let me use that as an example. The type of investments that do not recover are not well researched. In other words, we rely heavily on the fund managers to do a thorough due diligence again on the placements that they make. Obviously, there are duds that can come into play, like a Steinhoff. Henry and I looked at Steinhoff from a different perspective. We had a bit of a concern regarding the close relationship between Steinhoff and PSG. And what we did then is we started to test that question with all the fund managers, asking them how do they see the relationship between Steinhoff and PSG, and is it a secure and a good relationship? So we actually got a good answer from M&G, which is the old Prudential behind me. They said on their valuation methodology that they follow, they usually have 3 areas that they look at. They look at the share price itself. Is that price at the right level? And they've got analysis tools and quantitative tools to measure that. Secondly, if the share is undervalued or overvalued, there's either going to be a re-rating or a de-rating that's going to take place. And that may cause you to either buy the share or sell the share before any of those activities happened. And thirdly, dividend declarations. So if you have a company that makes a super profit, like Steinhoff did, but they never declare dividends, then there's a red light that comes out. And Prudential actually at that stage when they were still Prudential followed that rule and principle and therefore tried to keep away from Steinhoff as best they possibly could, because Steinhoff never declared dividends. and that's a huge concern. So that's typically the type of things that we do realize, Annelie, whereby we try and understand where a problem exists and what is the area that you need to avoid. And when we gather that from the different due diligences that we do, we can actually ask the fund managers whom we see if they follow that, if they pick up something negative in that specific area. So it may be not only on one asset class that it could be in one asset class that it could be negative. It can be in different asset classes at different points in time. So it may be in the bond environment, it may be in the equity environment, the offshore side, bonds, equity, cash, or property. Property, as an example, is a difficult thing still to assess. If I just look at our office block here where we are, 90% of it is still empty, and a lot of these people are still working from home. And interesting enough, they work for the World Bank. So we rent in the World Bank office park, and those World Bank employees are still working from home. So it's a interesting environment. Are you going to invest in property or not? So it differs from time to time. Samira, what is the fund manager's current view of Sussell shares? That's an interesting one, because if you look back in the Sussell share, there was a lot of issues when it went down to 20 Rand a share, and I can still kick myself for not buying Sussell shares at that point in time, although I kept on watching it. A lot of the fund managers had a concern. They were concerned that the rights issue will take place. And as one of the fund managers recently explained to us, when a rights issue is going to take place, you don't buy that share. But as soon as a right issue has taken place, in other words, the company has to start from a zero base again, basically. Then you want to be in that company because you'll have good growth. So Sussell is an interesting environment, still going through a lot of strategic changes internally. There's still a lot of selling off that taking place, a lot of Africa assets that are being sold off, which takes a lot of capital but doesn't produce enough income. The Lake Charles project, as we understand, has been put on hold, and we'll see if there's a buyer that comes up. If a buyer comes up and it buys that asset, there may be a lot of relief for Sussell again. But currently they're doing quite well. They are at a relatively stable place. The share price is looking good. And if one bought it at the time of COVID, it would have been great for us. Now, with the oil price having gone to where it is, Sussell is obviously making a lot of profit on the oil side as well. So it's very good for them as to where the oil price ran. It's pulling back slightly again, but unfortunately, you and I still have to go and pay a lot on petrol prices because of mainly the high or the low rand value. But overall, they are not negative on Sussell, but I would say they are neutral on Sussell at the moment. They're not buying or selling Sussell, but they are relatively neutral on it. Some guys that were very positive on it, I'm thinking about one specific fund manager. He bought up Sussell quite severely when it was down, but he was a Sussell supporter beforehand as well. And in having bought Sussell at a high level and it went down to the 20 Rand to a share price, you have to make it up in some or the other way, and therefore you buy the share at a low value and over time make up some of the losses that you've incurred on the other side. So there's strategic reasoning for buying certain shares as well. You can't specifically say that all the managers have the same view, but overall I would say a neutral view on it. We've designed, Annelie, again, we've designed our own strategy on applying investment principles, and our strategy is exactly what I explained here. Only a pleasure, Samira. We prefer looking at not necessarily a 5-factor strategy. We try and look at the factual happenings in the world, rather look at the political environment internationally, bring it down to the local environment, the political environment, try and deduct what's happening according to that in the economies. Look at the rand dollar, rand pound, rand euro exchange rates or different other exchange rates. And then we try and develop our own factors, if you want to call it that. And by looking at that, you get an objective view and a realistic view on what's happening. A lot of people always asks, but what modeling do you do going forward? We don't believe in that because we believe that what's happening is a current environment. So you have to be on top of it regarding what's happening at the moment. And if you understand what's happening in the moment, you can better assess or with a fair amount of positive probability, assess where the placement should happen and should not happen. So yeah, we've designed our own strategy. We're still refining it. It's taken us 15 years now to get to our strategy. We have a 7-page document in which we actually jot down our strategy, which we follow, which is if you want to call it, our IP. It took us quite some time for the employee benefit environment to understand what we're doing, because we're giving objective advice to the Board of Trustees and they make the final decisions on it. But thus far, it's been working very well for the fund. And the last 15 years, I think it's developed quite nicely. So you're more than welcome to make an appointment with us, Annelie. We'll sit and explain to you exactly what we follow and how we assess the allocations. And yeah, the strategy that we follow is probably a bit new, but I think it's very practical. On ShareMax, that's a pleasure, Annelie. On ShareMax, no, I don't have any detail on ShareMax. I can give you history on ShareMax. We looked at it when ShareMax came to the fore. Henry and I said, listen, we don't understand these returns that you get on these property investments. So what we did is we spoke to Investec Asset Management and specifically on Coronation on the property side as well. And we asked them what types of returns would they expect from a listed property company at that given point in time. And it was far, far below what ShareMax could offer clients. But then we went a bit further and we said, okay, what's the costing to ShareMax? So we looked at the commission that the brokers who sold ShareMax had. And I think it was in the region about 6% commission upfront that you received. And then there was a commission that was paid to the consultant who works for ShareMax, I think to the extent of 2 or 3%. And then obviously ShareMax has to put on their profit. So if you have a 6% plus a 3%, it's a 9% return you have to generate already. And then ShareMax has, let's say, a 2% profit that they made at that given point in time. Then you're looking at 11% return. And then if you declare a 14% return to a client, that means you have to perform at a rate of 25%. So that figure we took and we compared it to what Investec and Coronation told us, and they said a fair return value at that given point in time for listed property. Now that's the like of Menlyn in one city. Those type of properties were in the region of about 9%. So I mean, it just seemed ridiculous to us that you could do that. So what we did then is that we decided not to do any business with anybody that are invested in ShareMax. So we may be the very what would one call it, the more reserve type investors, if you want to say it, but I'm not going to go into that if there's uncertainty. Henry and I have got a principle which we follow. If we talk to a fund manager and he can't talk to us explaining what they do, and I cannot explain it to you. So as a board of trustee member or an individual employer or employee, I cannot explain if something is unclear to me. So we had one of these due diligences with a fund manager whereby the guy is very intelligent. He's got a number of engineering degrees and CFA charters, etc. Charter, and he explained stuff to us that after 2 hours we just asked him what exactly did he say in simple terms, and then he said to us, well, you don't have to understand what we say, you just invest with us. And we just nodded our heads and walked away very slowly. We're not going to venture there. We are not remunerated to go and invest in funny things. We are taking responsibility for people's livelihood, and therefore we would rather follow a responsible approach. Similar to like I mentioned Steinhoff earlier, We try to steer away from any fund manager that are allocated to Steinhoff. Unfortunately, when they had Swix as part of their portfolio, it was part and parcel of it, so you couldn't get away from it in totality. But yeah, we try and steer away and keep as conservatively aggressively as we possibly can, and with a high probability of success. That's what we try and adhere to. So I hope I answered that one. No share, Max.
Okay, Johan, thank you very much. Appreciate your time, and thank you to everybody for coming. I hope you found it interesting, and we look forward to talking to you in the future. And if I don't, well, I won't see you, will I? No, I don't even speak to you. But have a nice Christmas and New Year, and look forward to 2022. Thank you.